Welcome to StokTok's deep dive into JD.com. JD.com is one of China's largest e-commerce platforms, operating a marketplace where third-party merchants sell goods alongside JD's own retail inventory. The company also runs a logistics network and provides financial services, a vertically integrated model that differentiates it from pure marketplace competitors. For investors, JD represents a significant exposure to Chinese consumer spending and digital commerce. The stock currently trades in the lower half of its 52-week range. As of May 8th, the stock is trading at $30.13, roughly 21% below its 52-week high of $38.08. Let's work through the fundamentals, scene by scene, starting with a quick business overview. JD.com's core moat rests on three pillars. First, its proprietary logistics network. The company owns and operates warehouses and fulfillment centers across China, giving it cost and speed advantages over marketplace-only competitors. Second, the sheer scale of its merchant base and customer network creates network effects. More merchants attract more buyers, and vice versa. Third, JD has diversified into financial services and cloud computing, creating multiple revenue streams beyond core e-commerce. The company operates with high inventory turnover, tight supplier relationships, and a reputation for fast delivery, which translates into customer loyalty and pricing power relative to peers. Our StokTok score comes in at 40 out of 100, signaling caution across the portfolio. The score breaks down as follows: valuation strength at 17 out of 20, financial health at 11 out of 20, profitability at just 1 out of 20, growth at 9 out of 20, and smart money positioning at 2 out of 20. Now valuation. The question every investor has to answer: are you paying the right price? JD trades at price-to-earnings multiple of 17.06 times, which sits near the median for cyclical retailers, neither expensive nor cheap on face value. The PEG ratio, which divides the P/E multiple by the expected earnings growth rate, comes in at 0.73. This suggests the stock may be trading at a modest discount to growth expectations, a signal we find interesting. The enterprise value to EBITDA multiple sits at 8.91 times, a reasonable valuation for a capital-intensive business with significant logistics operations. The forward price-to-earnings multiple of 9.80 compresses meaningfully versus the trailing multiple, implying expectations for earnings improvement. Our discounted cash flow analysis suggests the stock is trading at fair value, a 0% margin of safety in either direction. Wall Street's consensus tells a different story. 36 analysts covering the stock have a mean price target of $40, with targets ranging from $25 to $61. That consensus target implies upside of roughly 30% from current levels. Taking both signals together, a reasonable fair value range in our view sits between $35 and $45. The market sentiment around JD leans bullish, supported by notable investor confidence and the company's successful completion of a 10 billion yuan debt offering earlier in the period, demonstrating strong capital access and institutional confidence in the franchise. However, broader geopolitical headwinds and sector-wide margin compression remain concerns. Moving to financial strength, how solid is the foundation? JD's Piotroski F-score, a 9-point scorecard of financial health covering profitability, leverage, and liquidity signals, comes in at 5 out of 9. That's below the median and suggests some financial stress or deterioration, a yellow flag. The Altman Z score, a bankruptcy risk model that combines profitability, liquidity, leverage, and solvency metrics, sits at 2.71, placing the company squarely in the gray zone, neither healthy nor in distress but worth monitoring. On the positive side, JD maintains a cash-to-debt ratio of 1.99, meaning the company has nearly $2 of cash for every dollar of debt, a solid liquidity cushion. However, interest coverage, the ability to pay interest on debt from operating earnings, comes in at just 1.24 times. That's tight. The company is earning only $1.24 for every dollar of interest expense, leaving limited margin for error if earnings deteriorate further. The current ratio, which measures short-term liquidity, stands at 1.22. That's above 1, which is good but not particularly generous. Debt to equity sits at 0.48, indicating moderate leverage. Overall, the balance sheet is adequate but not fortress-like. The company has liquidity, but profitability is thin relative to its debt load. Next up, profitability. Is this business actually making money efficiently? This is where the thesis falters. Return on invested capital, or ROIC, is just 0.82%. That means for every $100 of capital the company has deployed, it generates less than $1 of annual profit above its cost of capital. That is far below the cost of capital and indicates value destruction. Gross margin, the profit left after paying for goods sold, sits at 16.04%, reasonable for a retailer where inventory is a significant cost. But the operating margin, which measures profit after operating expenses, collapses to 0.27%. This tells us that overhead, logistics, technology, personnel, marketing, consumes almost all of the gross profit. The net profit margin, the bottom line percentage, is 1.48%. Even after financing costs, taxes, and all other items, the company is retaining only about 1.5 cents of profit for every dollar of sales. Free cash flow margin, cash the company generates after capital investment, stands at 1.31%, barely ahead of the net margin. The company is not efficiently converting sales into durable profit or free cash. Return on equity, which measures profit relative to shareholder capital, is 8.42%, single digits, and well below what investors typically require. Return on assets is 2.79%. These profitability metrics are the primary driver of the caution score. JD is a high-volume, low-margin business struggling to convert revenue scale into bottom-line earnings. On to growth. Is this business expanding, and at what rate? Over the trailing 3 years, revenue has grown at 7.4% annually. Over the trailing 5 years, the growth rate is 8.6% annually. Both figures are respectable but not exceptional, and they represent a maturing e-commerce market in China, where growth is slowing from the double-digit expansion of prior years. Book value growth, which measures how much shareholder equity is expanding, has grown at 6.1% over 3 years, roughly in line with revenue but slower than the cost of capital, which again reflects the profitability drag we identified earlier. The company pays a dividend yield of 3.36%, signaling cash return to shareholders. However, that dividend is modest relative to the capital base and reflects the limited free cash generation relative to balance sheet size. The Q1 2025 earnings results, reported roughly 51 weeks prior to this analysis, showed revenue growth of 17.80% year-over-year, which appeared strong on the headline. However, the company reported an operating loss of $4.55 billion and a net loss of $2.71 billion in that quarter, a warning sign that even revenue growth is being generated at the expense of profitability. Management beat earnings estimates, delivering $8.41 per share versus a consensus estimate of $7.09, but achieved that through accounting items and capital structure rather than operational excellence. The bottom line: JD is growing its top line at a moderate pace, but growth is not translating into earnings expansion. Now let's talk smart money, what institutional capital is actually doing with this name. 10 top-tier investment gurus currently hold JD, stock, a respectable number that suggests some institutional validation. However, the direction matters. David Tepper's Appaloosa Management, which holds JD as 1.74% of the portfolio, has reduced the position by 33.22%, a significant trim. Samantha McLemore's Patient Capital Management has reduced by 0.23%, a minimal change. Dodge & Cox Funds has cut the position by 35.11%, another substantial reduction. Christopher Davis's Davis Advisors has trimmed by 13.91%. Only Chase Coleman's Tiger Global Management has held steady with no change. The pattern is clear. Smart money is selling, not buying. Only 2.1% of institutional 13F filers, those required to disclose their holdings to regulators, are net buyers, meaning they are holding more shares than they are selling. That is far below the 50% threshold that would signal institutional accumulation. Insider ownership stands at 0.00%, meaning management owns virtually no shares. There have been 0 insider purchases and 0 insider sales in the last 3 months, complete silence from the people running the company. For a stock held by some of the world's smartest investors a few quarters ago, the exodus is notable. The low insider ownership is particularly concerning. It suggests management has limited personal skin in the game. And finally, the verdict. Let's bring it all together. On valuation, JD appears reasonably priced on both a PE basis and on analyst consensus, with a fair value range between $35 and $45 implying modest upside from current levels. On financial strength, the balance sheet carries adequate liquidity but tight interest coverage, placing JD in a gray zone of credit health, not distressed, but constrained. On profitability, this is the core problem. A ROIC of 0.82% and an operating margin of 0.27% indicate the company is destroying shareholder value at the margin. Earnings are insufficient relative to the capital deployed. On growth, top-line expansion at 7 to 9% annually is steady but unspectacular. And critically, that growth is not being converted into bottom-line improvement. On smart money, the pattern of institutional selling, particularly from established value investors who previously held the stock, combined with 0 insider ownership and 0 insider activity, suggests even the smart money is skeptical. In our view, a fair value range for JD.com sits between $35 and $45, representing upside of roughly 16 to 49% from current levels. However, the key question is not whether the stock is cheap. The key question is whether profitability improves. The Q1 2025 results confirmed what the StokTok score telegraphs. JD is a scale business struggling with unit economics. The company has built a franchise, but that franchise is not yet converting scale into returns on capital. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on JD.com. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.